If you enter the world of the stock market, your every move is a gamble and you have to make sure your every profit is a victory. But the real question for this is, when is the best time to sell a stock? Welcome to Financial Literacy. Here, we are dedicated and passionate about bringing you nothing but honest and straightforward facts about your money. We will help you take control of your finances and get you to the next level. Beginners or experienced, this is your one-stop shop for all things financial literacy. In this video, you will know when is the best time to sell stocks, so that you can maximize your potential income and make wise choices in the fast-paced world of stock trading. Now, if you're ready, without further ado, let's go! In the world of stocks, timing always matters. Would you buy an ice cream in winter? Of course not. Similarly, the stock market is all about timing. The right time to sell your shares determines your profit or loss. Selling too early or too late can make or break your investment. Stock prices are affected by various factors such as economic indicators, seasonal trends, market cycles, and company-specific news. Understanding these factors and keeping track of them can help you make informed decisions when it comes to selling your shares. Economic considerations. Alright, now that you know a bit, let's dive into economic considerations. Knowing when to sell stocks can determine the difference between a profit and a loss. Although most investors are familiar with the fundamentals of the stock market, they frequently ignore the significance of timing. Stock prices are influenced by a variety of factors, including the economy, seasonal patterns, market cycles, individual company characteristics, and technical analysis. We will go over each of these aspects in this article and offer advice on how to increase revenue. The state of the economy is one of the critical factors that influence stock prices. Investors must keep a close eye on the economic indicators that signal a company's financial health. Growth and expansion, inflation, interest rates, and unemployment rates all affect the market. Investors need to consider how each of these factors influences the company before buying or selling a stock. Moreover, before investing, investors should consider a company's revenue growth. The most accurate predictor of a company's potential for growth is revenue growth. A business that is always growing will probably keep growing, and its stock price will probably rise. It is vital to remember that expansion doesn't always translate into success, so always conduct extensive research. Next is knowing inflation. Inflation is the rate at which the general level of prices for goods and services is rising. Inflation is a critical factor to watch if you are investing in stocks, because it affects a company's earnings and purchasing power. A high inflation rate can mean higher costs for a company, resulting in lower profits. Another thing you should know is the interest rates. Interest rates represent the price of using borrowed money. Businesses and people take loans to fund their plans and buy things. When interest rates are low, it's cheaper for companies to borrow money, so they can make more money. However, when interest rates are high, companies might spend more on interest, which can lower their profits. The last thing you need to consider is unemployment rates. Unemployment rates provide a picture of the economy's strength. When unemployment rates are high, people are unwilling to spend, leading to a reduction in demand for goods and services. This scenario can negatively impact a company's revenue and profitability, resulting in lower stock prices. Seasonal trends. When we say seasonal trends, they are not just your typical weather patterns and pumpkin spice lattes. They play a significant role in the stock market. Let's start with the first quarter. As investors take profits from the prior year, this is the time when you will often notice a lot of stock sales. Since we're talking about January through March, it's not the best time to be very bullish. Make sure you are not left holding the bag by keeping an eye on your portfolio. Let's now talk about the summer slowdown. Trading volume typically declines from June through August. Prices frequently stagnate as a result of market uncertainty. If you're a long-term investor, don't get alarmed. This is just a normal occurrence during the seasonal cycle. Finally, the fourth quarter rally is a phenomenon that many investors look forward to. Historically, this is when the market tends to make big gains, especially in November and December. There are a few reasons for this, including holiday shopping and end-of-the-year portfolio adjustments. So if you're patient and strategic, you may be able to reap some significant rewards during this time. Market cycles. Investors often use terms like bull markets, bear markets, and the recovery phase to describe different phases in the stock market. A bull market is when stock prices are going up and people are feeling positive about investing. On the other hand, a bear market means stock prices are going down and confidence in the market is low. The recovery phase is the time when stock prices start going up after a bear market. Understanding these cycles is important for investors because they influence how stock prices behave. You should avoid buying stocks when the market is in a bear phase because prices are likely to keep dropping. But during a bull market, you have the potential to make significant profits by investing in promising stocks. One thing to remember is that market cycles don't follow a fixed duration. Sometimes, a bull market lasts for years, while other times a bear market may only last several months. Similarly, the recovery phase can vary depending on the severity of the preceding bear market. So keep an eye on the market cycle and align your stock selling strategy accordingly. But at the same time, don't get too caught up with timing the market. It is essential to focus on the fundamentals of the companies you're investing in and not just the market cycle. Company specifics. Now that we've covered the economic considerations, seasonal trends, and market cycles, it is time to dive into some company-specific factors that can impact the best time to sell stocks for maximum profit. First and foremost, it's important to analyze a company's financial data before making any investment decisions. This includes examining things like revenue, earnings, and debt levels to determine whether the company is financially stable and has a history of consistent growth. In addition to financial data, it's also crucial to keep up with industry trends when assessing a company's potential for growth. This means staying up to date on things like emerging technologies, changes in consumer behavior, and regulatory developments that could impact the company's bottom line. Lastly, mergers and acquisitions can also have a significant impact on a company's stock price. When a company is acquired or merges with another company, it can be a signal to investors that the company is on a trajectory for growth and expansion. Technical analysis. Lastly, the most often used technique among traders for stock market analysis is technical analysis. To forecast future price movements, it entails examining charts and other technical indicators. One of the most widely utilized technical indicators is the moving average. To provide a more realistic picture of a stock's long-term trend, they follow the average price over a given time frame while removing any short-term volatility. Another widely used method in technical analysis is the usage of trend lines, which are used to pinpoint important levels of support and resistance. Chart patterns are another important aspect of technical analysis. These are patterns that emerge on stock charts, which can provide clues about future price movements. Some of the most common chart patterns include head and shoulders, triangles, and double tops and bottoms. While technical analysis is not without its critics, many traders swear by it. By studying these key indicators, you can better understand the current market conditions and make more informed decisions about when to buy and sell. Well then, there you have it. Remember all of these and always make smart decisions to increase your chance of success. Thank you for watching. If you like this video, please don't forget to give a thumbs up, comment, and hit that notification bell so you don't miss out on our following videos.